What if I told you the difference between $999,000 and $1 million isn't $10,000? It's everything. Because at $1 million invested, the math doesn't just add up anymore. It takes over. Your money stops needing you. It starts working a second job. A job that never sleeps, never calls in sick, and never asks for a raise. Most people spend years chasing that number without realizing that once they cross it, the entire game changes. The rules of saving don't apply anymore. The rules of risk don't apply anymore. Even the rules of time don't apply anymore. This is Ron, and on this channel, we automate the path to financial freedom, one system at a time. Before we get into it, do me a favor, hit that like button and subscribe, because today we're breaking down something I call the $1 million rule. And once you understand it, you will never look at your portfolio the same way again. Let's start with the simple math, because the math is what makes this rule so strange. If you invest $1 million and it grows at a historical stock market average of around 7% a year, that's $70,000. Not from a paycheck, not from a side hustle, not from working a single extra hour. $70,000 from money simply existing in the market. Break that down further, and it's about $190 a day. Every single day, weekends included, holidays included, while you sleep included. Now compare that to where most people start. If you have $10,000 invested at that same 7%, you're earning about $700 a year. That's barely $2 a day. The system is working, but it's working in whispers. At $1 million, that same system is no longer whispering. It's shouting. And that's the first part of the rule. Growth doesn't scale in a straight line. It scales like a snowball. And somewhere around the $1 million mark, the snowball stops being something you push and starts being something that pushes itself. This connects to something a lot of financial planners call the 4% rule. The idea, which comes from research into how long a portfolio can sustainably last, suggests that you could historically withdraw about 4% of your invested assets per year, adjust that amount for inflation, and have a strong likelihood of never running out of money over a typical retirement. On $1 million, 4% is $40,000 a year. That's not a hypothetical number. That's close to the median individual income in many parts of the world. Except this income doesn't require you to show up to an office. It doesn't require a boss. It doesn't require your time at all. It just requires that the money already exists. This is why so many financial automation strategies are obsessively focused on getting to 7 figures as fast as possible. It's not about the number for the sake of the number. It's about the moment the number starts paying you back in a way that's actually meaningful. But here's where it gets interesting, and where most people get blindsided. Crossing $1 million doesn't just change your income potential, it changes your psychology. And this is the part nobody warns you about. When you have $10,000 invested, a 10% drop in the market costs you $1,000. Annoying? Sure, but survivable. You barely feel it. When you have $1 million invested, that same 10% drop costs you $100,000. In a single bad month, you can watch more money disappear from your portfolio than most people earn in 2 or 3 years of working. The percentage is identical. The emotional weight is not even close. This is what's called sequence of returns risk, and it becomes far more real once your balance is large. Early in your investing journey, a crash is actually a gift because you're buying more shares at a discount, and you have decades for the market to recover. But once your portfolio is large, and especially once you start relying on it for income, a crash at the wrong time can do lasting damage because you may be forced to sell assets at a loss just to cover your living expenses. The same market, the same volatility, but a completely different level of consequence depending on which side of the $1 million line you're standing on. This is exactly why automation matters more, not less, once you get closer to this number. A lot of people assume that automation is a beginner's tool, something you set up when you're young and broke and don't know what you're doing yet. The truth is the opposite. Automation is what protects large portfolios from the single biggest threat to long-term wealth: human emotion. Think about what automation actually does. It removes your ability to panic sell during a crash because the contributions and the rebalancing are already happening on a schedule, regardless of how the news headlines make you feel that week. It removes the temptation to time the market because you're buying consistently whether prices are up or down. And it removes the friction of decision fatigue because the system runs whether you're paying attention or not. The investors who actually make it to $1 million and beyond are almost never the ones picking hot stocks. They're the ones who built a boring, repeatable, automated system years ago and simply let it run while life happened around it. There's also a structural piece of this puzzle that deserves attention, and that's where your money actually lives. Not every dollar in a $1 million portfolio is treated the same way once tax season arrives. Money sitting in tax-advantaged retirement accounts grows differently on paper than money sitting in a standard taxable brokerage account. Some accounts let your contributions grow without being taxed every year along the way. Others give you a different kind of benefit depending on the rules of your specific country and account type. This isn't a video about tax strategy specifically, and everyone's situation is different enough that it's worth speaking to a qualified professional about your own accounts. But the general principle holds across almost every system in the world. Where your money sits can be just as important as how much of it there is, because two people with identical million-dollar portfolios can end up with very different amounts of usable, spendable income depending entirely on account structure. Diversification matters more here too, not less. At smaller account sizes, a concentrated bet that goes wrong is a painful lesson. At $1 million, a concentrated bet that goes wrong can erase years of disciplined, automated investing in a matter of weeks. This is part of why so many long-term investors lean toward broad, diversified index funds rather than betting heavily on individual companies once the portfolio reaches a meaningful size. Spreading risk across hundreds or thousands of companies instead of a handful doesn't eliminate volatility, but it dramatically reduces the odds of a single bad decision undoing a decade of disciplined, consistent work. It's also worth talking about what actually changes day to day, because it's rarely as dramatic as people expect. Crossing $1 million doesn't usually feel like winning the lottery. There's no confetti moment. Most people describe it as a quiet shift rather than a loud one. A creeping sense that decisions which used to feel terrifying, like switching careers, taking a slower year, or weathering a temporary income gap, suddenly feel survivable instead of catastrophic. The portfolio becomes less of a number you check anxiously and more of a foundation sitting quietly underneath everything else you do. That shift in how safe you feel making decisions is, for a lot of people, the real prize. The income is wonderful, but the optionality is what changes how you actually live. Now let's talk about what tends to go wrong right after people hit this milestone, because there are a few extremely common mistakes. The first mistake is stopping. People treat $1 million like a finish line instead of a starting point. They slow down their contributions or stop them entirely, thinking they've made it. But remember the math from earlier. $70,000 a year in growth on $1 million is incredible, yet it's still being generated by a base that continued contributions would only accelerate. Stopping at the exact moment your money starts working hardest is one of the most expensive mistakes in personal finance. The second mistake is lifestyle creep. As the portfolio grows, so does the temptation to treat unrealized gains like spendable cash, a bigger house, a nicer car, more frequent upgrades. The problem is that markets don't move in a straight line, and lifestyle expenses are far stickier than investment gains. It is much easier to increase your monthly spending than it is to decrease it later, and someone who scales their lifestyle to match a temporary high in their portfolio can find themselves in serious trouble during the next downturn. The third mistake is abandoning the boring strategy that got them there in the first place. Once people see a large number in their account, there's a strong psychological pull toward more sophisticated investing, concentrated bets, speculative trades, trying to time the next big move. But the diversified, automated, low-cost approach that built the first $1 million is usually still the best approach to build the second, third, and fourth million. Wealth is rarely built by getting clever. It's built by staying consistent for longer than most people are willing to. The fourth mistake, and this one trips up even disciplined investors, is forgetting that a portfolio is not the same thing as cash flow. $1 million sitting in invested assets can feel like total security, But markets don't hand out money on a fixed schedule. There will be months and even years where returns are flat or negative, and pulling income directly out of a shrinking portfolio during one of those stretches can lock in losses that take years to recover from. This is why so many people who reach this milestone still keep a separate cushion of cash or short-term, lower volatility assets set aside, specifically so they're never forced to sell their long-term investments at a bad moment just to cover this month's bills. The portfolio is the engine. The cushion is what keeps the engine from being raided during a rough patch, which brings us to one of the most underrated parts of the $1 million rule, the snowball effect on the road to the next million. Going from $0 to $1 million is, for almost everyone, the hardest part of the entire journey. It typically requires years, sometimes decades, of consistent saving and investing, because in the early years, your own contributions are doing almost all of the work. The market's returns on a small balance are small in dollar terms, even if the percentage is identical to what a larger portfolio earns. But going from 1 million to 2 million is a different story entirely. With that same 7% average return, your portfolio is already generating $70,000 a year before you add a single additional dollar of your own money. Add consistent contributions on top of that, and many people find that the second million arrives in roughly half the time, or even less, compared to the first. This is the part of compounding that feels almost unfair when you finally see it in action. The snowball isn't just getting bigger, it's rolling downhill faster with every turn. Let's make this concrete with a quick hypothetical example. Picture two people, we'll call them Marcus and Sarah, who both invest consistently and reach $1 million in their portfolios at the same age. Marcus decides he's done. He stops contributing and just lets the market do its thing. Sarah keeps her automated contributions running exactly as they were, say $500 a week, on top of her existing balance. At a 7% average return, Marcus's portfolio still grows meaningfully over time through compounding alone. Money left untouched for decades can roughly double every 10 years at that rate. But Sarah's portfolio, with continued automated contributions stacked on top of that same compounding, pulls significantly further ahead. The gap between them isn't small. Over 20 or 30 years, that consistent extra contribution, combined with the growth already happening on the first million, can mean a difference of hundreds of thousands, sometimes over $1 million, by the time they both reach retirement age. Same starting point, same market, same returns. The only difference was whether the system kept running. What makes this example so important is that neither Marcus nor Sarah did anything especially impressive after hitting $1 million. Marcus didn't make a catastrophic decision. He didn't panic sell or chase a risky trade. He simply stopped adding fuel to a fire that was already burning well. Sarah didn't do anything heroic either. She didn't pick winning stocks or time the market perfectly. She just kept the same automated system running that got her to 7 figures in the first place. The entire gap between their outcomes came down to one decision: keep going or stop. That's the quiet, almost boring truth at the center of the $1 million rule. The moment your portfolio starts working hardest for you is precisely the moment most people are tempted to stop working alongside it. That's the entire idea behind the $1 million rule. It's not really about the number 1 million as some magical figure. It's about the fact that this is roughly the point where compounding stops being theoretical and starts being undeniable. It's the point where your portfolio's own returns start to rival or exceed what most people earn from a full-time job. It's the point where your biggest risk shifts from not having enough to managing what you have poorly. And it's the point where the habits that got you here, consistency, automation, and patience, become more important than ever, not less. So how do you actually apply this rule to your own situation, whether you're at $10,000 or $500,000 today? First, automate your contributions before you automate anything else. A fixed amount, moved into diversified, low-cost investments on a set schedule, removes the single biggest variable in long-term investing, which is your own changing emotions and motivation. Second, treat market drops as fuel, not as fear, especially while your portfolio is still in its early growth phase. The shares you buy during a downturn are the ones most likely to deliver outsized growth on the other side of the recovery. Third, resist the urge to graduate into complexity. The strategy that gets most people to $1 million is rarely complicated. It's diversified index exposure, low fees, and time in the market. That same strategy tends to be exactly what should continue carrying you toward 2 million and beyond. And fourth, understand that the goal was never the number itself. The goal is the system that produces the number. Because once that system is running on autopilot, the number takes care of itself. So here's the real takeaway from today. $1 million isn't a finish line. And it isn't just a bragging rights number either. It's the point where your money's daily output starts to genuinely compete with your own. It's the moment compounding stops being a line on a chart and starts becoming a force you can actually feel in your bank account. The investors who get there fastest and who keep growing well beyond it almost never do it by getting clever. They do it by building a system, automating it, and refusing to touch it no matter how loud the market noise gets. If this video helped you see your own numbers a little differently, hit that like button, subscribe if you haven't already, and drop a comment letting me know how far you are from your own $1 million mark. I read every one of them. This is Ron. I'll see you in the next video.